Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us this week here, where we can cover some of the points that we found we wanted to share with you from our investment meeting that we have on Monday. We've got two to dive into today. The first is on rate cut expectations, which has evolved quite a bit. And then Andrew's going to break down the drawdown that we've begun to see in the S&P 500 and what we need to be looking for going forward. So let's dive right into the Fed. We got news last week that's been watched heavily each month. That is the Consumer Price Index report, CPI. That is one of the inflation metrics. It's not the most preferred that the Fed uses, but they usually walk hand in glove together with the one that the Fed watches, the PCE. And we've had the third straight month where it has beat expectations or been more, and showing some stickiness or some stubbornness to the inflation numbers. And as a result, we've seen a dramatic shift in the way the market views potential rate cuts by the Federal Reserve. When we came into the year, we were fresh off the heels of the Fed opening the door to rate cuts after having so many rate increases over the last couple of years. In fact, this chart shows you the number of rate cuts expected by the market as we go week by week through 2024 so far. And you can see at one point, 7 cuts were expected. The dotted line is where the Fed has been all along. They haven't changed. And it's worth noting, as of this point in time, there has been no change in the Fed's official forecast. So they still have 3 penciled in, but the market week by week has priced out the market cuts. In fact, there's a 13% chance based on market odds that there's no cut at all. So still overwhelmingly 87% chance that there is a cut, but their odds are of only 1 or maybe 2 cuts as we go through the rest of this year. And so that's had big implications for bond prices, especially as we go out into the longer part of the curve. We're beginning to see some steam pick up where the 10-year Treasury has risen at one time in the 3s, but now well north of 4.5%. So as always, that commands a lot of our attention and a lot of our adjustments through the portfolio as we see the market price in and price out rate cuts. So that's the bond side. We'll flip it over to Andrew and talk about the stock side.
All right, thank you, Adam. So we're starting to see a little bit of decline in equities. We're still pretty close to that 52-week high. But since the fact that we really haven't seen much volatility this year, the fact that the market is down over the last 10 days is getting some attention. And so I think this is important, and a topic that we talked about on Monday in our allocation meeting is at what point do we start actually getting concerned and start really paying attention to the decline in the market? And what I have to refer back to is the paper that I wrote last year called the 5% Canary that won the Founders Award, it won the Charles Dow Award, and was something that was highly respected and read across our industry. And it was looking specifically at when the market declines by 5% and when that happens in a very short period of time. In my paper, I wrote about it declining 5% in just 15 days, essentially 3 weeks. And so right now, the market through Friday was down 2.5. With the little bit of weakness we're seeing this week as we record on Tuesday, the S&P is down about 3.6. Dow's down a little bit more than that. But at this point, we're 12 days in to the market being off that high. And so we're really more concerned with how long it takes us to get to 5%. And we're not there yet. We still have several different key levels that I'm watching for the market that is going to need to break through before we start seeing a 5% decline. But we try not to get too heavily focused on just small ebbs and flows of the market. Something we talk about many times in this Market Carver is that some volatility very much is normal and an active and expected part of investing throughout the year. Typically, we do see small declines throughout the market or throughout the year. But turning again to why 5% is important, if looking at the chart on your screen, when we see the market drop 5% very, very quickly, that's where we get those red lines and the red dots on your screen. We typically can see the market see more protracted declines. We saw that happen in 2022. In January of 2022, the market did decline very quickly to hit 5% in a very short amount of time. And then we saw ultimately a mini bear market. On the other side, we have those green arrows on the chart when the market takes a long time to decline by 5%. Now we can start looking at more recent examples. Look at last year. The market took a long time to eventually get down by 5%, and we saw a very shallow, roughly 10% correction that was very quickly bought back up as the market rallied into the end of the year last year. And so these are just some examples of when the market takes a long time to decline by 5%, and when it does it very quickly can give us some insight into what potentially could unfold for that downturn and whether we start seeing maybe a rebound or expect that we could start seeing further weakness. And of course, this doesn't always work every single time. Nothing in the market does, but it gives us a way to quantitatively evaluate the market, take the emotion out of what's happening on the downside as the market starts to experience some weakness, and really look at it from the math, look at the numbers, the raw data to determine how do we best need to be positioned? Do we need to start de-risking? Do we need to start taking action? But again, not getting caught up in just 2, 3, 4 small declines, small ebbs and flows, because again, those are very normal parts of the market. We're really concerned with those much larger, impacting your journey, your financial journey, impacting what can happen in the portfolio. And we're watching this day by day and having these conversations on our allocation team to really make sure we're taking a risk appropriate actions within the models and portfolios that you entrust us with.
Very good and very helpful as always, Andrew, and especially in the context of a lot of the elevated geopolitical risks. I know that's got a lot of attention around the globe, and it should. And this is just one way that we've got to look at really where the portfolios are impacted. We can see geopolitical events that have caused markets to increase or decrease, but we really want to be analyzing what's happening in the actual market, which can have a mind of its own. So thank you for keeping us glued to what matters. And thank you to all of you for giving us a few minutes of your time. We truly appreciate it. As always, as a reminder, give us a call if we can be of service, 1-800-928-4001, or scan the QR code and book it electronically. So thanks again. Have a great weekend.